Greetings, and welcome to another installment of Viewpoints by Hennessy. My name is Eliot Bishop. I'm a portfolio strategist at Hennessy Funds, and today I'm joined by Masa Takeda, the head portfolio manager for the Hennessy Japan Fund. Masa, it's great to see you again.
Thanks for having me.
So I believe that you called this back in November at our CIO forum. You had said it's possible that the Japanese equity market would outperform the S&P 500 this year. Year to date, that's been the case. So what are some of the things that have been driving that performance?
Yes, so I think there are two groups of companies that drove performance year to date. One is the beneficiaries of AI data center build out, driven by the unprecedented spending by the hyperscalers. Japan, it doesn't really have the powerful frontier AI models of its own, like in China or the US. But Japan does have a handful of companies that produce critical components for AI data centers, such as optical fibers, optical components, and also AI chips, semiconductor materials, as well as equipment that is used to make those high-end chips. So that's one group. The other group is natural resource related names and energy sector. So oil exploration companies and general trading houses. Berkshire Hathaway is now the largest shareholder of 5 general trading houses in Japan. They have high exposure to natural commodities. And those sectors perform very well leading up to 2026 on the back of so-called debasement trade as investors they look for ways to hedge against the declining fiat currencies. And then more recently, the huge spike in crude oil prices in reaction to the U.S.-Iranian conflict in the Middle East.
And then how are some of the current geopolitical tensions influencing your outlook for the Japanese market this year?
So from a neutral perspective, I must say a prolonged war will have a negative impact on the Japanese economy, simply because an overwhelming share of imported oil comes from the Middle East. And so while household energy costs have been rising sharply, the Japanese yen has also been weakening in response to rising geopolitical risk. And this is going to weigh on Japan's current account balance because a weaker yen increases not only the cost of imported oil, but also imported goods more broadly. So it will add to inflation, widening current account deficit, which in turn could depreciate the Japanese yen further. So there's a little bit of vicious cycle element. To be fair, this dynamic is actually the same across all Asian economies because of higher dependency on Middle East crude oil. Now, we do think that it is too premature to become pessimistic or make any full assessment of the situation. I think it all depends on the duration of the conflict. And also, once the end of war is in sight, we believe that the sentiment and the fundamentals will reverse very quickly. And especially for Japan, the secular corporate governance reform story will come into focus again. And so we don't want to miss that opportunity. Lastly, Japan has gone through a lot of challenges. Asian financial crisis, global financial crisis, global pandemic, some challenges also that were specific to Japan, like 2011 great earthquake or Fukushima nuclear disaster, and Japan's own bubble in 1989, which collapsed in the 90s. And Japan, despite all these events, made a comeback. So, Japan always proves to be resilient.
All right, then. Well, how will some of the recent maritime disputes with China and some of the softer Chinese tourism that you've kind of witnessed over time impact Japanese companies?
The most recent diplomatic tensions began late last year in November, when the new Prime Minister Takaichi expressed support for Taiwan, and that prompted the Chinese government to retaliate against Japan through trade restrictions and also discouraging Chinese citizens from traveling to Japan. And that resulted in a sharp drop in the number of tourists from China to Japan. And that has impacted some sectors like department stores. But if you look at the statistics, the decline has largely been offset by visitors from other countries like Korea, Taiwan, Hong Kong, and the US. And so net, global tourism, inbound tourism in Japan is still growing. Now, the diplomatic tensions such as this are not new for the two countries. So back in 2010s, we had several occasions where the two governments were at odds with each other over, for example, territorial dispute in eastern China Sea. But the key thing to remember is that underneath the government tensions, we continue to see enthusiastic Chinese consumers, at the individual consumer level. They always have very strong appetite for Japanese products and services, whether it's consumer electronics, gaming devices, or cartoon animation character items. So we think this time around, the pressure is going to be only temporary.
Alrighty, and then how have some of the recent market moves influenced your conviction in some of the existing holdings in your fund? And have you found any opportunities to make any adjustments?
So we continue to hold our high conviction names, and among the largest holdings, I would like to highlight 7&I and Oryx again. And my answer for this question may be a little bit longer compared to other questions I will answer. So both of these names have very strong margin of safety and continue to offer very compelling upside. So on valuation front, forward price to earnings ratio for 7&I is still in the low teens, and this is based on cash-based EPS. 7&I, the 7-Eleven convenience store operator, reports under Japanese accounting standards, which distorts the true earning power of the company. But based on cash-based earnings, it's very much undervalued compared to the market. Free cash flow yield is almost 10% based on our estimates. And even last year's, even after Couche-Tard's merger offer being withdrawn last year, we think there's limited downside risk. The company management, under renewed pressure from the shareholders, they are now executing aggressive share buyback program. And also, there also remains possibility that a new suitor may emerge any day because the 7-Eleven franchise continues to be attractive. Oryx, it is financial services and alternative investment house. Their business model is based on principal investment model, using their own balance sheet to deploy capital and generate returns. if you take into account unrealized gains on their various investment assets, their share price is still below per share net asset value. In terms of upside potential, engagement with management is the highlight for both of these names. At Seven and I, we have engaged with management last year and have driven some changes at the company that led to the board appointing a new CEO. And we're not likely the only shareholder that demanded management change, but we think we played a role in this outcome. And we are very much encouraged to see signs of improvement for their same-store sales numbers. And also, the new management is now accelerating their execution to transfer Japanese-style convenience store model to overseas. At Oryx, we have been having constructive dialogue with the management, including the new CEO. We've been discussing a range of topics, mid to long-term growth strategies, as well as we raised issue with the company's communication with the capital markets about how they think about their own intrinsic value. As the company shifts towards more asset-light, third-party capital investment model, we believe that the company's the stock valuation matrix will shift from a net asset value basis to a P multiple basis, and that gives us a lot of upside from here. So all in all, we think these two positions will be a source of differentiated returns in this very uncertain environment going forward.
Alrighty. And corporate governance reforms remain a major structural theme in Japan. So what meaningful changes have you observed recently in how companies are approaching ROE targets, shareholder returns, or capital allocation?
So the corporate governance reform in Japan, in essence, it's all about improving returns on capital, or ROE, which is an area where Japan lagged for many years versus global peers. And the movement really started about 10 years ago when Stewardship Code and Corporate Governance Code were introduced in 2014, 2015, respectively. And since then, a number of government-led initiatives have been put in place. And fast forward to today, Japan's ROE improved indeed from 5%, 10, 15, 20 years ago to a little over 9% today. But that's still very low compared to international average. But the good news is that we now entered a stage where private sector companies are now more proactively embracing this reform. And so we think that Japanese ROE will continue to improve more independently going forward. The second point is the Financial Services Agency has started looking into revising the existing corporate governance code for the first time in 5 years. And previously, the Financial Services Agency mainly targeted companies with price to book less than 1 times. The corporate underperformers, because half of the market was trading less than 1 times book. Now, this time around, the main target will shift to sort of blue chip companies with price to book over 1 times, because they tend to hoard cash, always excess surplus cash on their balance sheets, diluting their returns on capital. So the upcoming revision will likely address this issue, and that should serve as a fresh catalyst this year.
All right. And then global demand tied to AI infrastructure and semiconductors has accelerated. How are Japanese companies getting involved? And are there any stocks in the strategy that you'd like to highlight?
So there are three companies from our portfolio that will fit this theme. Tokyo Electron, Shinetsu Chemical, and Hitachi. So Tokyo Electron is Japan's largest semiconductor production equipment maker. And they're one of the four largest globally, alongside Applied Materials, Lam Research of the US, and ASML of Europe. Without Tokyo Electron, there's no AI chips. And so with the increasing demand for memory chips, Tokyo Electron is now seeing a strong tailwind. We like Tokyo Electron because they have developed very deep and long-term relationships with the like of TSMC, anchored by technological roadmaps. So this is a very high switching cost business, that creates high entry barriers. Shinetsu Chemical is the world's largest silicon wafer manufacturer, and their high-grade wafers are needed to make GPUs and HBMs. The purity level of their silicon wafers is really mind-boggling. We're talking about 99% and 9 nines after the decimal. And, this type of high-quality wafers can only be produced by two companies in the world, Sumco and Shinetsu. So Shinetsu should be a major beneficiary going forward. And then lastly, Hitachi. Hitachi is a power grid solution provider. They acquired a division from Switzerland's ABB a couple of years ago. And as you know, obsolete power grid infrastructure has become a bottleneck in AI data center build out, and Hitachi's capabilities can help remove that bottleneck. So these three companies, we are very looking forward to continued growth.
Great. And then I know there's another theme of home builders that you talk about pretty frequently and have put in some of your shareholder letters. What are some of the things that you've seen recently in the U.S. market that have kind of reaffirmed your conviction in the home builder space?
Yes. So this trend, I think, is still not widely recognized by the stock market. That the Japanese home builders have been stealthily building market share in the U.S. Through savvy acquisitions. Even in the last 3 months, there were several acquisitions announced, with Sumitomo Forestry acquiring Tri Point Homes of the U.S. For a little over $4 billion, and Daiwa House purchasing through its local subsidiary TrueMark another local home builder as a bolt-on acquisition. And so now we have three Japanese home builders, Sekisui, Sumitomo Forestry, and Daiwa, now competing in the vast yet fragmented U.S. housing market, and two of them now among the top 5 by units, and those are Sumitomo and Sekisui, and even Daiwa is among the top 20. Now, what's interesting is that Japanese players are the only foreign players actively participating in this vast U.S. housing market and effectively competing with the local U.S. home builders. We think the key thesis for these names is that, for one, we obviously look into the eventual recovery of the U.S. housing demand. it is getting pushed out to the second half of this year, maybe beyond 2026. But for Japanese homebuilders, US is definitely a promising market compared to the domestic housing market. And more importantly, we believe that the Japanese homebuilders can leverage the Japanese style manufacturing excellence. So they have very cost efficient production techniques such as factory-based prefabrication and the use of pre-cut materials. And so they can deliver high quality homes to quality focused home buyers. So we think this is a trend that is not fully appreciated by the market, and this is going to be a very long-term thesis for us.
Great. And then in your response to the first question, you already mentioned Berkshire Hathaway. Can you comment just a little bit on the significance for the new 2.5% stake that they took in Tokio Marine?
Yes. So this was a very positive news. And in fact, from our long-held positions, Tokio Marine marks the second investment made by Berkshire Hathaway following Mitsubishi Corporation. Now, the nature of the strategic partnership. So this entails, number one, Berkshire Hathaway and Tokio Marine will jointly pursue M&A opportunities. And also, second, Berkshire Hathaway is going to underwrite part of Tokio Marine's insurance portfolio. Now, on the investment side, Berkshire Hathaway they have announced that they will invest 2.5% stake in the company. And better yet, they said they are open to investing up to 9.9% of the company's outstanding shares. And so we think it's a huge vote of confidence. Now, over the last few years, I have been making the bull case for Japanese insurance companies, non-life insurance companies, because of two distinct features. One is over many years of industry consolidation, we only have 3 insurance companies left, general insurance companies. And between them, they control 90% market share with very strong pricing power. And to our knowledge, there's no other insurance industry outside of Japan that has this kind of market share concentration. So that makes it a very, very attractive industry. Secondly, they all have extremely asset-rich balance sheets, consisting of what they call strategic equity holdings. These are shares of their corporate insurance clients that were acquired back in the 1960s. And today, they are sitting on billions or tens of billions of dollars in unrealized gains. And the management teams of these companies are now wisely using these hidden assets to fund their growth initiatives or boosting their shareholder return policies. Again, we don't know of any insurance industry with this kind of asset-rich balance sheets. So we invested in insurance companies, all 3 of them in 2022. And at that time, the Japanese accounting standards adopted by these Japanese insurers differed significantly from IFRS used by foreign peers. And that led to the earnings numbers significantly understated, so the share prices were highly attractive. With this Berkshire Hathaway announcement, we are happy to maintain the positions in all 3 names going forward.
Great. And then, in closing, I just figured I'd ask, is there anything else that we haven't covered yet regarding Japan's prospects for growth that you'd like to highlight before we sign off?
So, obviously the near-term outlook is still very much uncertain. But we do think that Japan's corporate governance reform will continue to make progress regardless of macroeconomic conditions. And that should be the biggest single driver of the market in the coming years. Now, Japan, because of its homogeneity, there is, they tend to adopt change gradually, and that sometimes creates, reluctance and resistance to rapid shifts. But once momentum builds, it can really turn into very powerful structural trend. So we think it should not be underestimated just yet. We think this will continue to be the biggest driver going forward. It's still in the early innings. And then lastly, Japan is still it's a market where active managers can add a lot of value because of market inefficiencies. And those inefficiencies mainly come from the language barriers, differences in accounting standards, and also unique corporate culture that is very different from the Western countries. And so we think that creates opportunities for investors.
Well, great. Well, so I would just like to thank you for taking so much time out of your day, and thank you for getting up so early to do this interview today, Masa. It's great to see you. And I'd like to thank all of our listeners and viewers. And if you'd like to find any more information about the Hennessy Japan Fund or any of our other Hennessy Funds product, please visit us on the web at hennessyfunds.com. Thanks, everyone.